Have you ever wondered how to become a truly successful trader, consistently earning profits and enjoying peace of mind at night? Today, I will lay out the precise journey to transform you into that confident, profitable trader who knows their every move. Yet, here's a crucial observation. Most individuals entering the trading world are essentially navigating a treacherous mountain climb. They attempt this ascent without any proper guidance or a clear route, completely unaware of their current standing. They lack foresight regarding the challenges ahead or the potential pitfalls lurking around the corner. The inevitable consequence? They find themselves repeating the very same costly errors, cycle after cycle. But imagine if you possessed a comprehensive guide, a detailed blueprint for your trading evolution. A map that meticulously outlines the 5 essential phases every trader must conquer, from novice to expert. With such a tool, you would pinpoint your exact location on this developmental trajectory. You'd clearly see what lies ahead and understand the precise actions needed to advance. Consider this video your ultimate navigational chart for this challenging yet rewarding journey. It breaks down the path into 5 distinct stages, making the complex process manageable. For each phase, I'll reveal its telltale signs, the common traps, and one critical step to overcome it. This is your opportunity to stop wandering aimlessly and start building a deliberate, successful trading career. Now, let's embark on this walkthrough, dissecting each stage step by step. Unfortunately, many traders operate without a clear roadmap, oblivious to their current standing in this complex journey. They remain uncertain about the characteristics of the next developmental phase or the specific pitfalls that lie ahead. This lack of guidance often leads to a frustrating cycle where the same errors are repeated persistently, year after year. But imagine having a precise guide, a map that clearly delineates the 5 crucial stages every trader must navigate. This map details the entire progression from a complete novice to a fully accomplished professional. With such insight, you would accurately pinpoint your current location, understand what comes next, and identify the exact action needed to progress. This video, in essence, serves as that very map presenting these 5 essential stages. For each distinct phase, we will unveil its typical indicators, the common snare, and the singular effective counteraction. Let's now begin our detailed exploration, commencing with the very first stage. Stage 1 is characterized by a fundamental lack of self-awareness regarding one's own deficiencies in knowledge. Newcomers often approach the market with a hopeful conviction that finding the ultimate setup, indicator, or mentor guarantees profitable outcomes. This is the Holy Grail syndrome, a dangerous illusion that a singular solution can magically eliminate all trading losses. However, the most perilous aspect of this initial stage is the misleading phenomenon of beginner's luck. A single, fortuitous win can incorrectly affirm your perceived skill, triggering a dopamine rush and reinforcing false confidence. This flawed lesson is amplified in markets like crypto, fostering a moonshot mentality, or Forex, which often leads to a leverage trap. This includes the leverage trap and one critical, specific action that often follows. We will now systematically examine each distinct phase of a trader's development. Stage 1 begins when you are completely unaware of your own lack of knowledge within the markets. Your brain, through beginner's luck, incorrectly learns that taking risks inherently means you are correct. The options market similarly entices with seemingly cheap out-of-the-money contracts, presenting them as an irresistible deal. Then, inevitably, the market bestows upon you a rather unwelcome gift in your trading journey. This comes in the form of a significant drawdown, a financial loss severe enough to truly force an awakening. Such a painful experience usually serves as a stark reality check, marking the typical end of the first stage. A quick self-assessment. Do you still believe one indicator or perfect entry will prevent all losing trades? If your answer is yes, then you are almost certainly still operating within the confines of stage 1. Your essential next step involves undertaking 20 trades, each executed at a micro position size. Crucially, these trades must adhere to a fixed stop loss and a strictly defined risk per trade. Your only goal during this exercise is to verify whether you consistently followed your stop and sizing rules. The focus is not on winning or losing, it's purely on disciplined adherence to your established trading plan. This disciplined practice then paves the way for stage 2, which is when you finally admit the seductive promise of rapid wealth often cultivates a moonshot mentality, while forex trading frequently ensnares individuals in a perilous leverage trap. Options 2 tempt with seemingly cheap out-of-the-money contracts, presenting them as an irresistible deal to unsuspecting traders. However, the market eventually bestows its own harsh gift, a significant and painful drawdown severe enough to finally awaken you. This challenging experience typically concludes stage 1, forcing you into a much-needed reality check about your trading approach. A quick self-assessment can confirm if you're still in stage 1. Do you believe a single indicator, mentor, or perfect entry will eliminate all trading losses? If so, that mindset firmly places you within stage 1, still searching for an illusory, flawless solution to market challenges. Stage 2 truly commences when you finally make a crucial admission. Okay, I genuinely don't know what I'm doing in this market. But instead of calmly establishing a solid trading foundation, most individuals unfortunately fall into a continuous loop of system hopping. They'll implement one particular trading method for merely a few days without giving it adequate time to prove its efficacy. Upon encountering an inevitable streak of losing trades, they quickly abandon the strategy, concluding that the method itself is inherently bad. This leads them to immediately purchase a new trading course or acquire a different, highly touted indicator. They might also seek guidance from a new mentor, constantly chasing the next holy grail in their trading education. The more information they absorb from these various sources, the more profound their confusion becomes, resulting in analysis paralysis. This state is characterized by an abundance of theoretical knowledge, but a critical absence of practical, decisive execution. Another common pitfall is developing a dependency on trading gurus or external signals, as taking someone else's calls makes losses feel less personal. Continuing within this second stage of development, traders often begin to grasp the concept of risk management, yet frequently misapply it. A common error involves prematurely moving their stop-loss order to break even, driven by an underlying fear of losing. Alternatively, after experiencing a single loss, many succumb to the urge to revenge trade, desperately trying to recover their capital. If you find yourself in this second stage, the issue isn't a deficiency in knowledge. Instead, your primary challenge lies in the absence of a clear, disciplined structure for your trading activities. For the next month, your immediate goal should be to completely halt the intake of any new information or strategies. Focus intensely on mastering just one specific trading setup, allowing no other distractions to cloud your judgment. Limit your analysis to a single, consistent time frame, ensuring a focused and unwavering approach. Furthermore, define and adhere strictly to one specific trading window each day, cultivating disciplined habits. Crucially, maintain a detailed journal, meticulously documenting only your execution errors rather than focusing on profit and loss. This disciplined approach to structure is precisely what paves the way for progression into the next phase. Stage 3 represents a significant breakthrough, an aha moment where understanding truly solidifies. Here, traders realize that success isn't about predicting market movements with perfect accuracy. Instead, trading is fundamentally a business centered on the skillful management of probabilities. It's about understanding the likelihood of certain outcomes and positioning oneself strategically to capitalize on them. Often, when relying on others' advice, the sting of a loss feels somewhat less individual. Stage 2 is also a period where individuals begin to grasp the concept of risk, yet frequently misapply it. This often manifests as prematurely shifting your stop loss to break even, driven purely by fear. Alternatively, a single loss might provoke emotional revenge trading in an attempt to recover immediately. For those navigating stage 2, the issue isn't a deficiency in knowledge, but rather a critical absence of structure. Your immediate objective for the coming month should be to halt the intake of any new information or strategies. Concentrate solely on a single trading setup, one specific time frame, and a consistent trading window. Focus your journaling on recording execution errors rather than solely tracking profit and loss figures. This disciplined structural approach is precisely what becomes evident and crucial as you progress to stage 3. In this phase, you cease to question if a particular trade will succeed, instead asking if the setup holds positive expectancy over many repetitions. Crucially, you learn to separate your personal identity and self-worth from the individual results of your trades. A single profitable trade doesn't signify genius, just as one losing trade doesn't render you incompetent. Each trade is merely a solitary piece of data within a larger statistical sample. Stage 3 is characterized by the clear, objective definition of your trading edge based on specific conditions, not vague intuitions. An effective trading plan is formulated with if-then statements. If conditions A, B, and C are met, then specific entry, risk, stop, and target parameters apply. A precisely defined trading plan, with its objective rules, significantly diminishes the capacity for emotions to interfere. This clarity ensures that subjective feelings do not override the logical execution of trading decisions. If one had to identify the primary distinctions separating professional traders from amateurs, it wouldn't be their entry strategies. Instead, the true differentiator lies in their rigorous and consistent approach to risk management. The fundamental truth in trading is that no single losing trade will be the ultimate cause of your downfall. Rather, it's the accumulated impact of a series of trades, if poorly managed, that ultimately leads to ruin. Consider that a 50% loss on your capital then demands a daunting 100% gain merely to return to your starting point. Experienced traders are acutely aware of this pitfall and meticulously avoid falling into such deep drawdowns. A straightforward yet highly effective standard involves risking only a specific percentage of your total equity per trade. This typically ranges from 0.5% to 2% of your capital, adjusted according to your particular trading style. The absolute key to this strategy is to maintain unwavering consistency in your risk allocation for every single trade. Furthermore, it's essential to view a stop loss not as a penalty for making an incorrect judgment. Instead, it should be regarded as a critical form of insurance protecting your trading capital. You are, in essence, paying a modest premium to ensure you can continue participating in the market over the long term. With these robust risk management principles firmly in place, a trader then transitions into what is known as Stage 4. Clearly defining your risk parameters, including precise stop and target points, significantly minimizes the influence of emotional decisions. If there's one key differentiator separating professional traders from novices, it's not their entry points, but rather their comprehensive approach to risk. This is because a single losing trade rarely ends a trading career. A detrimental sequence of poorly managed trades, however, certainly can. For instance, a 50% capital loss demands a 100% gain just to break even, a perilous trap professionals meticulously avoid. A straightforward standard involves risking a small, predetermined percentage of your total equity for each individual trade. This typically ranges between 0.5% and 2%, a figure you carefully adjust based on your specific trading style and strategy. The crucial aspect here is to maintain this calculated risk percentage consistently across all your trading activities, without deviation. It is within this advanced stage 4 that traders typically begin to experience genuinely consistent and reliably positive results. However, achieving correct execution still demands conscious effort and discipline, as emotional impulses persist even at this advanced level. A peculiar yet accurate indicator of reaching this stage is when the actual process of trading itself begins to feel rather unexciting. Professional traders thrive on structured routines, starting with pre-market checks of news calendars and marking crucial price levels. During the trading session, they only execute trades that meticulously satisfy all criteria on their predefined checklist. Post-session, they diligently maintain a comprehensive trading journal, recording far more than just their profit and loss figures. Their journals meticulously track maximum adverse excursion and maximum favorable excursion, alongside tagging specific emotions like fear, greed, or confidence. Ultimately, in stage 4, steady consistency far outweighs intense bursts of activity, often leading to fewer but higher quality trades. Stage 4 marks the point where consistent trading results begin to materialize, though maintaining this status often incurs a small cost. Even at this level, correct execution still demands conscious effort, as impulsive tendencies continue to persist. A surprising yet truthful indicator of this stage is when the act of trading itself starts to feel rather unexciting. Despite the developing consistency, Stage 4 is not without its formidable challenges, often likened to boss fights. The most significant adversary encountered here is what's termed God mode, a dangerous state of overconfidence. This trap typically emerges after a string of successful trades, tempting one to slightly increase their position size. Traders might also begin to subtly disregard their established rules, mistakenly believing themselves to be immune to market risks. However, this overconfidence often leads to immediate repercussions when even a standard market reversal occurs. Experienced traders rarely fail from a lack of knowledge, but rather from the pitfalls of complacency and excessive self-assurance. Beyond God mode, another prevalent challenge is the psychological burden of performance anxiety. As a trading account expands, the escalating figures can exert considerable pressure on one's mental state. The consistent remedy for these psychological obstacles remains a steadfast commitment to foundational trading principles. This involves adhering strictly to percentage-based risk management, diligently following a checklist, and maintaining a disciplined routine. Successfully mastering these challenges paves the way for Stage 5, where trading actions become almost instinctive. In this advanced stage, market decisions and executions occur with near-automatic precision, requiring minimal conscious deliberation. In Stage 4, the emphasis shifts from intense activity to steady, consistent execution. You focus on fewer actions, but perform them flawlessly time and again. However, Stage 4 still presents significant challenges, akin to boss fights in a game. The most formidable of these is known as God mode. This God mode typically emerges after a series of successful trades, luring you into a false sense of invincibility. You might then feel tempted to incrementally increase your trade size, believing you've cracked the code. Simultaneously, there's a subtle urge to relax your established trading rules, even if just by a small margin. But then, an ordinary market reversal strikes, and suddenly, those slight deviations lead to substantial losses. Experienced traders don't falter due to a lack of understanding. Their downfall often stems from different weaknesses. They typically succumb to complacency and an inflated sense of self-assurance, leading to critical errors. Moving into stage 5, your trading becomes almost an automatic response, not reckless, but exquisitely refined. You develop an acute ability to swiftly grasp the market's context, processing information with remarkable speed. The rhythm of price movements, the velocity of candles, and key liquidity zones are instinctively felt, a result of countless observations. This state of flow isn't some mystical sensation, but rather the effortless execution of the correct action at the precise moment. Ultimately, true mastery teaches that trading is fundamentally a game of energy management, both mental and physical. This means understanding that a lack of sleep or a tired mind signals it's time to refrain from trading altogether. The pinnacle of stage 5 involves discerning precisely when to step aside, recognizing that choosing not to trade is also a professional judgment. Even for the same individual, the pace of acquiring trading proficiency can vary significantly based on the specific market chosen. Take cryptocurrency markets, for instance. Their continuous 24/7 operation leads to a unique time compression. This constant activity means encountering volatility more frequently, which can accelerate the learning curve for traders. However, this rapid pace also carries a substantial risk of exhaustion and burnout if not managed carefully. Moving to the foreign exchange market, it's characterized by its immense liquidity, but also by frequent disruptive price fluctuations. For those engaging in scalping, a strategy of small, frequent trades, an exceptional tolerance for this market noise is essential. In contrast, stock markets offer defined trading hours, which can provide a welcome mental break and a chance to reset. Yet, navigating equities can also lead to information overload from endless company news and complex macroeconomic analysis. With these differences in mind, a crucial piece of practical advice emerges: focus your efforts. It's recommended to select just one market, a single time frame, and a specific trading window to begin your journey. The temptation to absorb all knowledge simultaneously should be resisted, as it often proves counterproductive. To quickly summarize the journey so far, stage 1 of a trader's development is marked by an initial sense of illusion. Following this, stage 2 often plunges the trader into a period of profound despair as realities set in. But there are more stages to explore, with stage 3 representing the next significant phase in this progression. We are now poised to delve deeper into what stage 3 entails for a developing trader. A critical professional decision for any trader involves selecting the right market, as this choice can profoundly impact your learning trajectory. Consider cryptocurrency markets. Their relentless 24/7 operation and constant volatility can accelerate learning, but also bring a significant risk of burnout. The forex market, while highly liquid, is often characterized by considerable noise, a factor scalpers must learn to skillfully navigate. Conversely, stocks offer structured trading hours, providing clear mental breaks, yet they demand extensive analysis of company news and macroeconomic trends. Our practical advice is clear: commit to mastering one market, one specific time frame, and a consistent trading window. Avoid the temptation to absorb all knowledge simultaneously. Focused effort will yield far greater results in the long run. Now, to consolidate our discussion, let's briefly revisit the 5 distinct stages that mark a trader's journey of development. Starting from the initial illusions and subsequent despair, The path leads to stage 3, centered on understanding probability and managing risk. Following this, stage 4 demands consistent routine and unwavering discipline to solidify one's trading foundation. The pinnacle, stage 5, is achieving a state of effortless flow in your trading, coupled with the crucial insight of knowing when to step aside. With this comprehensive overview of the trading journey complete, we encourage you to reflect on your own progress. We'd love to hear from you. In the comments below, please share which stage, from stage 1 to stage 5, best describes your current position. Your valuable participation helps us all understand this complex path better, and we truly appreciate your engagement. Thank you for joining us on this exploration of trader development. We look forward to connecting with you again very soon. Until our next discussion, always remember the cornerstone of success. Maintain unwavering discipline in your trading endeavors.